Okay, so today we're gonna dive into something that's probably top of mind for a lot of you out there, especially if you're dealing with, huge amounts of data or, super important digital systems. We're talking cyber insurance.
Yeah, and it's one of those things that can be a real headache to figure out.
Hmm.
You see all these policies and premiums, and it's tough to really know if you're getting the right protection for your specific needs.
Yeah, exactly. And I feel like a lot of the time we end up just kind of, going with the flow, like comparing basic coverage and price. But is that really enough? Like, are we really getting the best value for our money and really mitigating our risks?
Right, and that's exactly what we're going to dig into today. We're going to explore a totally different way of looking at cyber insurance,
Hmm.
a more dynamic and insightful way to actually evaluate those policies and potentially save a ton of money in the process.
And what really got us interested in this whole topic was this really cool YouTube video we came across from Manage X Value.
Yeah, they're doing some really interesting stuff with risk quantification, and they have this new feature in their platform that really changes the game when it comes to understanding and evaluating cyber insurance.
It's not just about, comparing policy documents side by side anymore. This is about getting a much deeper understanding of your risks and how those risks are actually being transferred and mitigated by the insurance you have.
Exactly. So for this deep dive, we're going to be focusing on the ideas presented in the transcript of that Manage X Value YouTube video. It's called How to Evaluate Cyber Insurance Policies with Risk Quantification.
So let's get down to brass tacks here. The core of this whole new approach is something called a risk quantification graph model. Can you break that down for us? What is it and why is it so important for figuring out cyber insurance?
Okay, so imagine this. Instead of looking at each risk separately,
Yeah.
like, oh, we could have a data breach here or a system failure there, this model pulls everything together. Gives you
Wow.
like this big picture view of all the potential risks your organization faces and what their financial impact could be.
So it's like seeing the whole forest instead of just individual trees.
Exactly, and they call it a loss exceedance curve. It basically shows you the likelihood of different levels of financial loss across your entire business. You can see the whole spectrum of risk.
And the cool thing they talked about in the video was the ability to kind of slice and dice this data, right? So we can see the big picture, but we can also zoom in on specific areas that are really important to us.
Yeah, that's what makes it so powerful for making real decisions.
Yeah.
You can focus on, what's the total potential financial hit from all risk events combined, or you can zero in on one specific event that you're really worried about, like let's say a massive data breach in your customer database.
Yeah, because not all risks are created equal, right? Some have a much bigger potential impact than others.
Right, and the best part is that loss exceedance curve. You can apply it to those specific risks too, so you can see the likelihood of different levels of financial loss just for that one event.
Yeah.
Gives you this amazing level of granularity.
So it's not just about saying, hey, we have cyber risk, let's get some insurance. It's about understanding the nuances of those risks and then tailoring your insurance to match.
Exactly. So now you can actually see, what's the likely financial fallout if this specific thing happens, and then you can evaluate whether your insurance policy actually covers that adequately.
Okay, so we're starting to get a much clearer picture of our risk landscape, but how do we actually use this to evaluate specific insurance policies? Is there like a way to plug the policy details into this model?
Yes, and that's where it gets really interesting. They showed how you can map out the specifics of your insurance policies right within the model. They used this example of two simple policies, both dealing with client data loss, but one covering consumer banking data and the other focused on investment banking data.
And I'm guessing even though they're calling them simple policies, there's still a lot of complexity under the hood, right?
Oh, yeah, absolutely. A single policy can have all these different layers. It can cover up to 10 different areas. But to keep things clear, they just focus on one coverage area for each example.
So how do we actually define what each coverage area protects us against?
So here's where that slice and dice thing comes in handy. You can define coverage based on specific threats like ransomware attacks or phishing scams. Or you can focus on specific systems or parts of your infrastructure that are vulnerable. And just like in those examples, you can define coverage for very specific events, like the loss of a certain type of data, regardless of how it happened.
And for bigger companies, I imagine you can even specify which departments or business units are covered by each part of the policy, right?
Exactly. So you're not paying for coverage you don't need
Sure.
or, leaving crucial areas exposed.
So we're getting really specific now, but there are also those financial details, right? Like deductibles and payout limits. How do those factor into this model?
Yeah, so for each coverage area, you can set the copay amount, the annual deductible, and even a deductible for each risk event if that's part of the policy. Then you define the maximum payout for a single event and the overall annual payout limit for that area.
Yeah. So we're building this really detailed picture of how each policy works financially, but they also talked about defining coverage for impact areas. And it sounded like that goes beyond just the immediate financial losses, right?
Yeah, that's a really important point. So traditional insurance usually focuses on those direct costs, like how much did it cost to recover your data after a breach? But this platform lets you define broader impact areas, things that might not have an immediate dollar value, but are still critical to your business.
Like damage to your reputation or loss of customer trust.
Exactly. Those things can have huge long-term consequences, even if you can't put an exact dollar amount on them right away.
Right. And that's the kind of stuff that can keep you up at night, even more than the immediate financial hit.
Absolutely. And the video makes it clear that while you can model these strategic impacts in the platform, insurance companies mostly care about those direct financial losses. So when you're defining coverage in the platform, you're basically saying which of those direct financial impacts the policy is supposed to cover.
Okay, so we've got our risks mapped out. We've got the details of our policies plugged in. What happens next? How do we actually see how much risk is being transferred by the insurance?
Okay, so once you have all that in place, the platform does this amazing risk transfer analysis. And the key takeaway here is that transferring risk through insurance isn't free. There's a cost. And this analysis helps you compare that cost to the potential benefits.
So how does it show us this? Is it like a chart or a graph or something?
Yeah, they use this really clear chart that shows the expected payout from the policy versus the premium you pay. The expected payout is based on that loss exceedance curve and your coverage limits. It's shown as a green area on the chart. And then on top of that, they show the premium you're paying. That's the red area.
And I imagine the relationship between those two areas, the green and the red, is where the real insights come from.
Exactly. If the red area, your premium, is consistently bigger than the green area, the expected payout, it basically means you're probably overpaying for that coverage. You're spending more than you're likely to get back in a typical year.
Let's talk about that consumer banking data loss policy they used as an example. What did that analysis show?
So in that case, the premium was $13 million. And based on their risk assessment, the expected payout was a bit less than that, which they said was pretty fair. But then they looked at this thing called the excess payout likelihood, and that was 38%.
Okay, so what does that 38% mean in plain English?
It means there's a 38% chance that in any given year, the insurer would end up paying out more than that $13 million premium for consumer banking data loss events. So it's not a guarantee, but it's a significant possibility that the policy could really pay off if something big happens.
So a decent chance of a big payout, but not a sure thing. How did that compare to the investment banking data loss policy?
Okay, so that one had a much higher premium, $43.4 million. Again, they said it was pretty fair considering the higher risk of a major data loss in that area.
Higher risk, higher premium makes sense.
And
What about that access payout likelihood? Was it also higher?
Yeah, much higher. It was 78%. So in that case, it was way more likely that the insurance company would end up paying out more than the premium.
So why didn't they just get a lower premium for the consumer banking policy if the chance of a payout was lower?
Well, remember, the payout limit for both policies was $50 million.
No.
So even though the chance of a payout was lower for the consumer banking policy, the potential payout was much larger because the premium was so much lower.
So with the investment banking policy, they were more likely to get a payout, but the potential upside was limited because the premium was already so close to the payout limit.
Exactly.
Okay, so we've seen how this platform can help us compare our current policies to our actual risks. But what I found really fascinating was how it can show us the impact of investing in security improvements.
Yeah, that's where it gets really strategic. They call it dynamic evaluation because it lets you actually model how specific security investments will affect your risk profile. Let's go back to that investment banking example. Imagine they invest in some really strong data loss prevention tools, and they do some great employee training to prevent data leaks. What do you think happens in the model?
Well, if the investment works like it's supposed to, the risk of losing that sensitive data should go down, right?
Exactly. And when that happens, the expected payout from the insurance policy also goes down because the likelihood of a major incident has decreased. In the video, they showed the expected payout dropping to less than $10 million after the investment.
Wow, that's a huge difference. So now the policy looks way overpriced.
Exactly. The premium is still $43.4 million, but the expected payout is less than $10 million. So now you're in a great position to go back to the insurance company and say, hey, look, we've invested heavily in security. Our risk has gone down. You need to lower our premium.
And you have the data to back it up.
Right? You're not just guessing or, trying to haggle. You have concrete evidence that the risk they're insuring against has decreased significantly.
And that excess payout likelihood also drops, right? Because the chance of a big payout is much lower now.
Exactly. Went from 78% down to just 10%. So you have a really strong argument for a lower premium.
So this is all about connecting your security investments to your insurance strategy. It's not just about making yourself more secure, it's about potentially saving a ton of money on insurance.
Absolutely. And it doesn't stop there. The platform can also show you the impact of multiple investments over time, like a whole portfolio of security improvements.
So you can see how those improvements gradually change your overall risk profile and the value of your insurance policies.
Exactly. And this means you can continuously evaluate and adjust your insurance as your risk evolves. It's not just a once-a-year thing anymore.
And what about companies that have a bunch of different cyber insurance policies? Can this platform handle that complexity?
Yeah, it can actually combine and evaluate multiple policies together. So you get this holistic view of your entire insurance portfolio. You can see the total potential payout, the overall expected payout, and compare that to the total cost of all your policies.
So you can spot any overlaps or gaps in your coverage and make sure you're not overpaying for redundant protection.
Exactly. And just like with individual policies, you can see how your security investments impact your entire insurance portfolio. It's all about optimization.
This is seriously impressive stuff. So for someone listening to this who's responsible for cybersecurity or risk management at their company, what's the key takeaway here?
The key takeaway is that there's a much smarter way to approach cyber insurance. It's not just about comparing premiums and coverage limits anymore. It's about understanding your risks, quantifying those risks, and then using that data to make informed decisions about your insurance.
It's about being proactive instead of reactive.
Yeah.
It's about having data-driven conversations with your insurance provider and potentially saving a lot of money in the process. So here's something to really think about. How would proactively quantifying your risks and really measuring the impact of your security investments change the way you think about cyber insurance? Could it become less of a necessary evil and more of a strategic tool that actually helps you manage your risk and optimize your spending? What questions does this raise for you about your current insurance policies and your overall risk management strategy? Those are the questions we want you to be asking yourself as we wrap up this deep dive. Thanks for listening.